So recently I made a video about when not to take a swing trade. So if you go to my channel, if you notice here, see why when not to take a swing trade. So on this video, one of my YouTube subscribers made a comment and he said, can you make a similar video about positional trading? So the title of this video will be when not to take a positional trade. Okay, so we will look at positional trading just like we looked at swing trading in the context of market conditions in this video. So let's go to market conditions. So these are market conditions as per Market Smith. There are four types of market conditions: confirmed uptrend, uptrend under pressure, rally attempt, and downtrend. As a positional trader, what are we supposed to do when we see these market conditions? So let us first start with downtrend. In a downtrend, by the way, whatever I am saying, it's not my opinion. It's already given on MarketSmith website. All you have to do is just read. If you click here, see, they tell you what to do. Okay. But if you don't have that patience to read, or if you want somebody to explain to you what they are trying to say, I am here to do that work. Okay, I am trying to explain to you how to approach positional trading in different market conditions. And there are four market conditions. Let's talk about downtrend. When the market is in a downtrend, obviously we are not supposed to take a positional trade. This is as per Market Smith. It's not my opinion. Okay, we are not supposed to take positional trades. In fact, 50 to 75% of our portfolio or more should be in cash. And the remaining portion of the portfolio, which is already invested, the stop loss on those positions should at least be at break even because the market is in a downtrend. You might lose not only your profit but also your capital. So, downtrend is a complete no. When the market is in a confirmed downtrend, no new positional trades to be taken. Okay. Now let us look at confirmed uptrend. In a confirmed uptrend, we should focus on stocks that are fundamentally strong, but that may or may not be technically strong. What do I mean by that? So let's say a stock is fundamentally strong, but technically it has only 4 points in the base, and the yellow line, which is the buy point, is in the blue zone. So, for example, let's look at a stock called HPL Electric. I don't remember exactly the chart or the fundamentals, but let's see. The stock has been showing up on my radar. See, have a look at this stock. Have a look at this stock. I have drawn this base, long base here. So the buy point is here. Sorry. Where is that path? Okay, this is point 1. That's point 2. That's point 3. That's point 4. So there are 4 points in the base. Point number 3 somewhere here. That would be my buy point, correct? So this stock is technically weak. Sorry. This stock is technically weak because the yellow line is inside the blue zone. However, the point I'm trying to make is that when the market is in a confirmed uptrend, we are allowed to buy a stock that is technically weak but fundamentally strong. Now, for HPL Electric, I have not looked at the fundamentals. I'm just giving you an example. So, a stock which has 4 points in the base and the yellow line is in the blue zone, it's okay to take that trade because the market itself is in a confirmed uptrend. Everybody is buying stocks in this kind of a market. We can take that additional risk. So just to summarize, in confirmed downtrend, no new positional trade. In fact, 50 to 75% of our portfolio should be in cash. On the remaining stocks, our stop loss should be at break even just to avoid a capital loss. In a confirmed uptrend, we should focus only on stocks which are fundamentally strong, which may or may not be technically strong. And of course, the comparatives has to be strong in any case, in any market condition. A comparatively weak stock, we don't even want to look at that. Okay. Next, uptrend under pressure. In uptrend under pressure, we are supposed to focus on stocks that are fundamentally and technically strong. Okay, so now you see this is a weak market condition compared to confirmed uptrend, correct? So the weaker the market condition, the stronger should be or the stricter should be our criteria. So in uptrend under pressure, we are supposed to look at stocks which are comparatively, fundamentally, and technically strong. What does that mean? It means that the yellow line should be in the green zone. Try to buy stocks probably from the green zone only. Okay. Please understand that this is important because in the green zone, there is very less overhead supply. Okay. When there is less overhead supply, it takes not much volume to push the stock out of the base. Okay, so remember, when the market is in a uptrend under pressure or rally attempt, focus on stocks which are comparatively, technically, and fundamentally strong, which means buying from the green zone. Even if there are 4 points in the base, I would buy the stock from the green zone. In case if there are more than 4 points in the base, let's say 6 points, 8 points, and it is in the green zone, I would be that's like icing on the cake. Okay. So for these two conditions, we can buy stocks which are comparatively, technically, and fundamentally strong. But what's the difference between these two market conditions? Well, rally attempt is a weaker market condition compared to uptrend under pressure, right? So in a rally attempt, we can go in, but with a smaller position size. So what differentiates these two market conditions is the position size. As far as the strength is concerned, I consider confirmed uptrend as a strong market and these three as weak markets. So although they have divided the market conditions into four, I would split it into strong and weak, as simple as that. I like to keep things simple. Okay. So this is what we are supposed to do in a different market conditions. We can take positional trades even in weak market conditions, but our criteria has to be strong. This is number one. Number two, as we know, in a confirmed stage two uptrend, there are five bases. Okay, base one and base two is early stage, base three is middle stage, and base four and base five is uh, late stage. Base one and base two are investable bases, which means when I buy the stock and when I sell the stock partially, I would be reluctant to sell the stock because I bought the stock early. In a middle stage, if I'm getting 20 to 25% gain, I would probably sell most of my shares. I would not keep much of my shares. And in late stage, if I'm taking a positional trade, first of all, when the stock is in a late stage and the market conditions are weak, I would not even take the trade. I've already made that mistake recently in Zomato and Polymedicure. And by the way, are you taking notes while listening to what I'm saying? Okay, because these is just coming out of my mouth so fast. You have to pause the video and take notes, please. Okay, this is very important. I am discussing different market conditions in the context of positional trading. I am also discussing market conditions, positional trading along with base stages. Okay, so probably you will have to make some table to summarize this whole data, but do it yourself. Okay, I can do it for you, but you have to do it yourself. Unless you take notes, how will you learn? How will you become an independent professional stock trader? So let me repeat, if I am buying the stock is in the early stage, I will be reluctant to sell that position. I will keep some part of the position as long as the stock remains above the 50-day simple moving average. When I'm buying in base number three, that's a tradable base. That's not an investable base. So 20-25% gain, I would be happy to take that. Okay. If the stock is showing extraordinary fundamental strength, then I might keep some shares. And in late stage, I would try to avoid buying the stock because in a weak market condition, there is 80% chance that you will lose money when you buy in base 4 and base 5. Whereas if the market is in a confirmed uptrend and I'm buying a late stage stock, I might go in with a smaller position size. So you see, we can play with market conditions, positional trading, swing trading, base count, and position size. So these are the four variables that you have to juggle as a trader. Okay, so if you watch my video on swing trading and if you watch this video on positional trading, you will get a overall very good context as to what to do in what market condition, what to buy, when to buy, how much to buy, and why to buy. These are four questions that I have answered in both of these two videos. Thank you so much.